Welcome back. You're with us on Trading Hour. Our next guest is Nilesh Shetty, Portfolio Manager at Quantum Advisors. Now, Nilesh is roughly managing a $2 billion portfolio. Quantum Advisors is actually. And this is largely offshore fund. And the investors hail from North America and Europe. So it gives us a sense of how a lot of these foreigners are looking at the Indian markets right now. Nilesh, good to have you on the show. So before we dive in with your top bets, your investment thesis, let's get a sense on what the top-down view is on India at the moment, given the rally that we've seen in April and May, a rally that seems to be sort of slightly getting a bit of wobbly, if I could say, now as we round up the end of June.
I mean, the view has not changed materially. India remains a bright spot globally. A lot of investors, especially global investors, especially after the crackdown in China, decided that they will not allocate more capital there. So these are long-term strategic investors, not tactical investors. And you saw a lot of money coming into India. A lot of them are still in early stages of deciding their allocation to India or increasing the allocation to India. But again, there is no question that they don't like the India story. It is right now very attractive relative to the rest of the world. And given the kind of performance that the market has given post-COVID and relative to other emerging markets over long periods of time, it's just been a quite structural, secular bull run in some sense, or a positive macro story for people wanting to allocate to it.
Oh, no, that point is well taken, but the only risk is the valuations, right? India has always been a premium market in terms of valuations. And now with this recent run-up over the past 3 months, it's only gotten a little more expensive. Are you comfortable with the valuations? And is there any sector where you've lightened your positions, pared down your holding because it's gotten a bit expensive and overheated?
Yeah, see, India will always be expensive relative to sort of other emerging markets, primarily because of the quality of companies that are listed in India. A lot of these even though a lot of these emerging markets are clubbed together, the nature of companies in each of these geographies are very different. And if you were to rank Indian companies on margin profiles, on return ratio profiles, India will always be expensive. What we've seen over the last few months is the strong rally in small and mid-cap space, which is, again, not that liquid a space. And to allocate capital there is not easy. So even a small amount of liquidity coming there sort of jacks up valuations quite materially, which is sort of a concern for us. But apart from that, the larger companies, there is still significant value. So they were cheap and they've sort of moved back to their sort of long-term averages, but it's not expensive in any way. So we continue to remain bullish and largely allocated to the larger cap space. Recently, we've sort of trimmed positions in the consumer discretionary space, primarily in a large tractor company, and a slightly lower position in sort of a two-wheeler company. So again, the style is value. So we had built up a lot of positions last year and valuations were attractive and these companies were trading at sort of 2-decade low valuations. But given the run-up that we've seen this year in that space, we've reduced positions there, not materially, but marginally.
Okay, so you're saying not too much of a change to your stance, to your portfolio as well. Of course, you did mention some of the smaller changes. We were earlier on the show going through a very interesting note that Morgan Stanley has written on the internet companies, where they're sounding quite positive on long-term profitability. They are starting to look at these. A lot of, the new age companies as well, Nike, Zomato, PB Fintech, all of those. Do any of those interest you now, considering that valuations have corrected significantly from the peak?
Yeah, like I said, you have to be really, really long-term in trying to decide profitability for these companies. We would rather sort of value near-term profitability for companies. So there has been significant meaningful correction and we've been tracking that space. But when we try to model when do these companies start generating cash and throw up profits, it's still quite a while away. And a lot of that is still, even if you take current valuations, a lot of that is already in the price. So we watch it patiently, but we've never added any of these companies to the portfolio.
All right, got that. So still retaining a cautious view on some of these newer age businesses. Then let's talk old businesses and finances as old as it gets, right, Nilesh? And that's where you've had a pretty bullish call. And I think you've owned companies across the board, from banks to insurance to, I think, broking, etc. So how are you cutting this up now? Where do you find valuations still attractive within financials? And if you could throw in a specific word on life insurance, because that's where we've seen this hectic rally from the lows of February.
Yeah, so life insurance is a sector we were tracking very closely and was getting very interesting for us. Unfortunately, we could not add these names into the portfolio. They rebounded before we could add them. But we added names in the general insurance space, in the broking space, and we continue to have large positions in sort of top two private sector banks in India. So again, they've actually materially underperformed in the rally. And if you look at their valuations, they're not expensive at all. We continue to hold them. We think over the next sort of 3 to 5 years, they perhaps would lead the rally in equities as credit cycle picks up.
On consumer, where do you stand right now? The outlook just, seems to have improved now from a market point of view, given the progress of the monsoon. It's finally hit pretty much pan-India now. Do you think consumer is a space people should look at? Because there are tailwinds on the margin front?
Yeah, like I said, this year, a lot of the companies that were hit badly last year or due to higher raw material prices, they will show expanding margins. And a lot of the consumer companies will probably show that. Again, we have consumer discretionary names in our portfolio, two-wheelers and four-wheelers and stuff like that. But consumer staples has been very tough to justify in a value portfolio. We would like to own them, but at 60 times, 70 times earnings, you really have to take a very, very long-term view on earnings growth and stability of margins without any risk coming through to justify those valuations. So again, these are fantastic companies and everybody should at some point try to own them at valuations that they are comfortable with. For us, it's just been a valuation issue, nothing else.
Okay, Nilesh, we've been talking a lot about, some of these smaller pockets, the likes of defense, railways. Did you get in on any of those or, do you think that they still look ripe for investments at these levels? Defense, railways, real estate has seen a big run as well.
Yeah, so we did add a capital good company around that 2020 COVID crash period. And it has been it has done really well for us. And we've actually reduced a lot of our position there. Currently, valuations in that space looks slightly stretched. These are very cyclical companies and because government capex has been very strong, you've seen a sharp build-up in order book. But when you look at their valuations now, they are at the top end of where they should be trading. So right now we are just watching them closely, but nothing attractive to add in the portfolio. And the one that we have, we've trimmed it materially, actually.
Okay. All right. Good talking to you. Thank you very much for joining in, Nilesh, and we look forward to more conversations in the future.
Thanks.
We do need to take a quick break on that note with the news. The markets are still in that range, just about 22 points up on the Nifty. It's trying to kind of actually gain some more momentum on the upside, crawling its way towards the 18,700 mark now. So let's see. We'll take that break, come back with more on the other side.